Well, hello and a very warm welcome back to the Andrew Eborn Show, where today we're tackling the stormy seas of UK and global economy with the brilliant Vicky Pryce, Chief Economic Advisor at the Centre for Economics and Business Research, and a renowned voice on economic policy. We share more platforms than Paddington together. It's always a joy. Vicky's been front and centre lately, discussing the escalating trade war and Trump's tariffs in the tumultuous times shaking markets. With the UK 10% tariff from the US, global trade tensions rising, and economic planning more critical than ever. I'm delighted to get her take on what's next for the UK, how Trump's policies ripple across the pond, and practical tips for navigating this uncertainty. Vicky, a very warm welcome back to the show.
Thanks very much. Great to be on it.
It's always a thrill to have you. Look, you've highlighted how markets and the economy are in tumultuous times. That's an interesting way of putting it. How do you see the UK economy evolving in 2025 amidst these global trade uncertainties? And what key factors could either bolster or hinder its growth?
Okay, well, the interesting thing is that the UK has had lower tariffs imposed on it, or at least that's what everyone is discussing here in the UK, thinking that perhaps we've managed to get a better deal, but in reality we didn't, because if you look at the formula that President Trump has used, we should in theory have had zero tariffs, since we have either a very, very small deficit or a very small surplus in goods against the US for most years recently. So the formula should indeed have ended up with us, having tariff-free trade with the US. But we have had the 10% imposed nevertheless. And of course, we also have, and there are serious issues right now in the car sector, 25% on cars, and also parts are coming into effect as well. I think it's tomorrow that also parts are included in the trade barriers that have been now put against some of our goods. And also trucks. It's not just cars, it's vehicles more generally. And we're not bad in that area ourselves generally. But also, of course, 25% on steel and aluminium. And the discussion right now is what to do with the steel industry in the UK. Should we nationalize it? Because it is actually in great difficulties. One of the reasons that they are in increasing difficulty now is it is tariffs and whatever competition there might be. I think the expectation is that quite a lot of not just steel, but all sorts of other products and commodities may start finding their way into the UK, which would have gone otherwise into the US or perhaps into other places which are going to also find themselves in difficulty or trying to compete against each other. So there is going to be quite a scramble, really, to redirect trade where perhaps it would work best. But the UK is not going to be insulated from this, not by a long shot. So everyone is looking again at growth, what it will mean. Everyone is looking again at industrial policy. Do we have one? Should we be developing one faster? We've been promised to have an industrial strategy, perhaps coming out earlier than we think, perhaps in the next month or so, with some specific things that the government is going to be doing. But it's not an easy time for the UK economy. And the expectation is that perhaps the growth that we thought might happen of even 1%, which we thought was a bit low, might actually get worse.
Yes, no, we talked about 0.1% at one sort of stage. I was at BAFTA yesterday, as is my wont,
How
and
nice.
we were talking about obviously the UK media industry, and one of our greatest assets is our creative industries and shows licensed around the world, things like Downton Abbey. Is there now going to be a tariff on the programs that we export?
Well, it doesn't look like it for the time being that there is going to be anything at all on the services side, additional to whatever else there is, because it seems that President Trump has been focusing very much on the working population in the US, which is involved in manufacturing, and it is that bit that he wants to reverse the downward trend of, and that's basically where we are right now. So they have forgotten, of course, themselves that they have a surplus on services, the US, which reduces their overall deficit quite significantly. But yes, for the moment, as far as I can see, services are not affected. Equipment, maybe, but it isn't like what we see in Europe, where perhaps if you're taking your violin with you, you may have to get special permission or pay something extra. if
Yeah.
you're going to, to do a sort of musical sort of event
Yeah,
somewhere.
and I can see that from the performance side. I mean, obviously, a program is a product probably more than a service. So it's licensing, but it's going to be interesting to see how that pans out. And obviously, we import a huge amount of American content as well.
No, absolutely. I mean, the thing to remember is that we are very heavily involved ourselves in investing in the US and the US investing here. And that is really the great surprise about everything that's been going on, because quite a lot of American firms have been putting, or building factories or using affiliates or subsidiaries across the world, and then using that to either manufacture or perhaps just use the parts that might perhaps be produced in those places to then input into their overall manufacturing chain back into the US, sold as a product, or even added to in the factories that they have in the US, so they get the extra value added where some of the profits perhaps come. All that is going to be disrupted, so that you do really wonder, how the US will do. And we have seen Wall Street, really tearing its hair out, and saying some rather strong, or using some rather strong words against the tariff policy. Yesterday, we got more coming out from various leaders in the financial sector saying that this is not making much sense, because it is going to hurt the US particularly. With it, it will hurt the rest of the world as well. And the UK is no exemption.
Yeah, and it's interesting. And as you know, Elon Musk's father, Errol, is on my show all the time. And Elon's famously now saying, look, there should be zero tariffs. And he quotes that wonderful example about a pencil. You couldn't get a pencil made unless you had all
Yes,
sorts of free market
exactly.
forces. You make a very good point, Joe, saying it's all to be sort of reflective, if you like, of what the different policies are. We have zero tariffs on the US. Does Trump just not realize it?
Well, we do have tariffs on cars, for example. I mean, we have the 10% tariffs on cars, which is the same as as the EU does on US cars coming in. And we've kept that. So, when people are talking about a customs union, actually, we have kept quite a lot of the tariffs which the EU had been imposed in the past, even though we left officially in 2021. So we could reduce those. I think one of the negotiations that is going on right now is how do we reciprocate, if you like, in terms of Trump's demands that we should reduce our own tariffs and see whether anything happens. But the interesting thing is that quite a lot of countries, including the UK, had been going to the US, or at least talking to Trump, and offering all sorts of concessions. For example, the EU had been offering zero tariffs on any industrial products into the into the EU from the US. And nothing happened. So, there are negotiations apparently now. What is it? It was 50 before, now it's 70, I hear, in terms of the number of countries that Trump is talking to. But of course, as he said, there are rather a lot of them, and we don't have time to see them all sort of very quickly. So, but of course, at the same time, he's quite enjoying, while all this is carrying on, and tariffs have now been imposed, collecting a lot of extra cash because of the tariffs that are already being imposed. So in the billions already, and the calculation is that it would be about 600 billion a year, unless, of course, trade just collapses. In
Yeah,
which
unless
case,
some sort of companies such as Jaguar just stop altogether. I mean, that's the other thing.
which they have, of
Darren,
course.
yeah, so Darren Jones, the Treasury Minister, he's suggested the era of globalization might be over. Do you see this as a lasting shift or a temporary blip? And how should the UK reposition its economic strategy in response?
Okay, what we have seen, of course, is that globalization, in terms of the pace at which it was happening, has eased very significantly. It eased after the financial crisis, and then it eased again with COVID, and it sort of had stabilized. So the trade intensity of the world had sort of become, certainly wasn't improving, but had become, has started to look rather worrying, in that some of the IMF forecasts suggested a decline. So the trade intensity is looked at generally by just looking at exports and imports, and then looking at the percentage of world GDP. And if that one is going up, then obviously trade intensity goes up. If it's going down, it goes down. And it had been going up and down a little bit, but overall, really, if you took a pencil, if one can possibly use, again, the sort of Musk analogy and just used it to track across where we might be by the end of this decade. The expectation was that we'd be slightly lower in terms of trade intensity. So it was already happening pre the extra tariffs, because in reality, there were loads and loads of restrictions that were there already. Not only were there tariffs against, for example, Chinese electric vehicles, which already had 100% tariffs on them. It's not the first time that we have the 100% mentioned. So the big companies selling EVs across the world were not selling anything to the US from China. So because of that, they're all coming elsewhere. So we had sanctions. We had also restrictions in relation to the types of companies that were allowed to come and operate in particular parts of the world, including, of course, China. We've had the whole issue with Russia. So the world had started deglobalizing. And because of COVID, we also saw that for security of supply, we needed to have production happen closer to home. So there was a lot of onshoring that has been taking place for a while. So the trend was there. And growth for both for trade and for GDP had been adjusted for the global economy downwards anyway. So we were not going back to the pre-financial crisis rates of nearly 4% growth in the world economy, which is huge. And now we're lucky, we have 3% growth. And most of the growth, of course, happening in the emerging and developing world rather than the West. Well, this, if it continues, will lead, I think, to that deglobalization happening even faster. Of course, there are going to be quite a lot of parts of the world that are going to get closer together and say, okay, let's have free trade deals between us, and that's going to improve the situation. Yeah. But because this uncertainty is going to linger for a while, and even if those tariffs are now withdrawn, what I think we're going to be finding is that there is a lot less willingness to go out and invest. And productivity and growth will suffer. And I think that's the real problem. It's not so much, what percentage of globalization growth do we really want? It is, will people go out and invest anywhere, really?
Yeah. No, I think you're absolutely right on that. I mean, we say uncertain. The markets never like uncertainty. I mean, Trump said he was going to do this, so I don't know why people were so surprised.
I think it's the size of the tariffs that was surprising, and the nonsensical way in which they've been imposed, and the impact they will have on some developing countries in particular. And, look at Vietnam, for example. And we were hearing about some African countries which are really going to be hit. And of course, this is at a time when everyone is cutting back, including the US and us, on international aid. Yeah. And that's going to be a serious, serious problem. We worry about migration. Well, migration, if some of the countries do worse, is going to increase without any doubt. And we'll have extra social issues to deal with.
Yeah, no, absolutely. And the Bank of England, I mean, they've hinted at a potential interest rate cuts this year. How do you think this will balance the inflationary pressures from tariffs, something you flagged as a key issue, against the need to stimulate a sluggish economy?
Well, of course, it all depends on whether there are retaliatory tariffs that are imposed by the UK. Apparently, there is a list of 8,000 products that could have tariffs imposed on them. I didn't realize we're importing so many different products from the US, but we obviously do. So have the EU. I mean, they've got a list. They were ready to implement. They've delayed that. The idea that they will retaliate as of April the 15th, but whether they do, of course, is a different issue. And other countries might do the same. But in reality, tariffs imposed by a nation itself for anything coming in are generally inflationary. For the rest of the world, it's deflationary. And given that we're going to have low growth in the future, lower certainly than had been anticipated. I mean, the Bank of England already was forecasting just 0.75% growth this year, a lot less than many others. It was a shock when it came out with that a couple of months ago. And slowly everyone else was following anyway. Now everyone is adjusting to at least as low as that, if you see what I mean. So it could be lower. In that environment of relatively low inflation, yes, there are a few reasons why inflation may be higher in the short term in the UK, because we've added a lot to our water bills, to our council tax, to taxing our vehicles, to TV licenses, to the cost of stamps, transport, so going on trains, buses, etc. All that will temporarily lead to an increase in inflation, but overall, we're looking now possibly an even more deflationary prospect ahead. So yes, I think everyone is revising expectations. I think it is entirely likely that we'll see, 4 quarter-point cuts over the next few months, certainly by the end of the year, which will bring our interest rates down to 3.5%. It's interesting, actually, about the UK, because there's been a flight to safe assets, in inverted commas, away from shares. We've seen again, of course, overnight, the stock markets in Asia doing really rather badly. Not so much in China, but elsewhere. But of course, what has been happening is that, there's movement in and out of those safe assets, including gold. So there are times when money moves back to the stock markets, as it did temporarily yesterday, and gold fell in the last couple of days. But now, of course, money would probably be diverted back to it. But also money is going into bonds, and that is very, very significant. What is happening in a number of countries, including the US, is that the move into bonds means that the cost of government borrowing goes down, but also the cost of corporate bonds borrowing goes down, because basically kind of companies actually issue bonds, and they're also traded, of course, in the markets. And certainly government bonds, we've seen that their yields have gone down quite significantly because there's been quite a entrance into those markets. Not so much with the corporate bonds, which are, of course, under stress, a little bit like the shares. But what it means for government borrowing for the US and also from other places, including Europe, is that it's cheaper to borrow. And therefore, if you have a little bit of room for borrowing, you can go out and help your economy that way. And the EU is putting all sorts of measures into place already, thinking about what sort of fiscal support they can give to its economy. It's not really happening in the UK. And that is the concern, because we're already seeing it being more or less at the margin in terms of what we can borrow. And the fiscal rules have been so much discussed about, and everyone worries about it, particularly the Chancellor. Our bond yields have in the last few days gone up a little bit.
Right.
So it'll be interesting to see what happens now. The shares are beginning to go down again, and maybe there will be a reversal. But the markets have decided that actual interest rates will be coming down somehow. Mortgage rates are beginning to come down quite significantly. So there could be some reprieve for the poor consumer, who is going to find that perhaps, mortgage rates aren't as high as they had been anticipating, and where they have to remortgage, things will be easier, and also for businesses and for personal borrowing more generally. So yes, I think that's perhaps the one positive thing of all this that may happen.
Yeah, and it's good to have some positive news in amongst all this dire news that we heard. But you mentioned gold, and we've spoken about this on the program several times. It's normally viewed as a safe investment, and I think a number of people I've been speaking to were surprised that it went down. What's your take?
Well, it went down mainly because money moved back into shares. So it looked like, and there had been a rumor that all those tariffs were going to be postponed by 90 days. So that rumor meant that quite a lot of money went back into shares, and we saw recovery happening. So gold falls as a result of that. And profits are taken at various stages. But it is almost like the only safe asset there is. Yes, bond markets, as I said before, you can move into those, and they're slightly safer right now than shares. But there are some places where you do worry about sort of the fiscal sustainability of what those countries are up to, and I'm afraid one of them is the UK.
Yeah, I know you're absolutely right. It's either that or you keep your money under your bed.
Well, while interest rates are high and have remained high, lots of people have indeed put them in the bank. And you saw the savings ratio in the UK, for example, zoom up. Yeah. I think the latest indicators are it was at around 12%. If interest rates are coming down, of course, that could be reversed.
Yeah. I mean, given your focus, Vicky, on the broader implication of tariffs, how vulnerable is the UK to a global recession sparked by these trade policies, and what past lessons could help us weather the storm?
Well, one of the past lessons, of course, is Brexit and what's happened since we left, where the trade intensity with Europe has come down. Trade intensity more generally in the UK has come down. If you don't have trade, you don't have as high as it should be, then you don't have the growth in productivity. And the main reason is that there's less competition. You don't need to invest as much or innovate, and and everyone suffers as a result, and productivity suffers, which it has done quite significantly in the UK. So trade is good, and encourages growth and encourages all the other things that I mentioned, sort of better investment in more interesting areas and growth. And we've seen what's been going on. I mean, we've had the car industry announce that in February, where it had yet another contraction. I think it was a contraction for the 16th consecutive month, if I remember correctly, this morning, which is devastating. I mean, given also all those tariffs, I mean, you wonder what will happen next. And you mentioned Jaguar Land Rover earlier. Of course, they have stopped, for the moment, shipments to the US. At least now we know those tariffs are there and going to stay for a bit. Maybe they will do some of that. But, and of course, we know that the government has stepped in a little bit to help the car industry. But the car industry, I think, is feeling that this is very minor and is focusing much more on easing perhaps a transition to green and to electric vehicles, but nothing much more. I think a hugely bigger package is going to have to come to support the sector, like we're now considering perhaps in the steel industry, but I think it's much wider, and maybe even rethinking our priorities, because it's going to be survival that we need to be looking at in the next year or so until things get sorted out. I mean, maybe it will all be reversed and everything will be fine, but actually the hit to confidence is going to be so great, and it will take some time for that to be reversed. So yes, I think the UK, which is still a very significant trading nation, is going to be affected very adversely by all this.
Yeah, no, absolutely. And I always like to look at things from a different angle. People always around the world, all the commentators are saying, well, Trump's wrong and it's eventually going to be reversed. Let's look at it slightly differently. I mean, Trump called tariffs the most beautiful word, you'll remember, with his sort of rhetoric, aiming to make America wealthy again. Obviously, you've been very vocal, as indeed have others, about the economic fallout. How realistic is his strategy from a UK perspective, and what ripple effects might we see? And do you think he might be right?
Well, he wants to raise quite a lot of money. And that's the important thing, because, of course, he wants to implement tax cuts that he had promised he was going to implement. But he can't do it on the current basis. Well, perhaps he can, because, of course, the dollar still remains a major currency, and he can just print more dollars, I presume. And everyone will accept that. So if he is to raise a lot of money that way, which, of course, used to be the way in which the US was funded in the past, of course, it hasn't happened since really the Second World War. But until then, we had tariffs being quite an important part of the way in which the US fiscal side was managed. So it may for him make sense to carry on with some form of sort of bigger tariff imposition, which allows for that extra money that he needs to come in, and perhaps also redistributed to places which he had pledged he was going to help in his pre-election campaign. But there is also the issue of, possibly at the end of the day, I mean, listen to Musk, for example, who wants a free trade area with the US and the EU. We might discover that actually tariffs are such a bad idea, and maybe we'll end up with a considerably better environment after all this is sorted out. No tariffs, but actually imposing tariffs the way that he has done can only be harmful for the US and for the rest of the world. But if it leads to a rethink, which is a positive rethink rather than one that says, let's just all become a lot more protectionist, then that's not going to be good. If it leads to people realizing that actually we need to be working a lot more closely with the rest of the world, then that could be positive. But if it also leads to increased polarization, so that you find the BRIC countries, the Brazils, Russians, Indians, Chinese, and the global south perhaps getting closer together, plus lots of other countries in the Middle East, and having their own free, if one calls that, trade block with different currencies perhaps being used rather than the dollar for the trade. Digital is being discussed a lot. Then that would be quite interesting, because it will take away quite a lot of the strength of the US. Maybe it will be a new multi-dimensional world that actually a small country like the UK may find difficult to navigate.
Yeah, no, interesting. So the general advice then for UK businesses and investors, I mean, obviously it's a very volatile market at the moment, as you say. The suggestion even that there was going to be this 90-day reprieve made the market very positive again. And of course, it didn't happen, so they all collapsed again. What should investors and UK businesses do to protect themselves?
It's really quite difficult, but getting closer to like-minded bodies makes huge sense. So, for example, the EU, and investing in the areas where you have a little bit more certainty than what's going on right now in the US. But I'm afraid a number of them may well be considering, and in fact have already considered and talked about it and actually have done it, is move production to the US. There will be an element of that, but for the vast majority of smaller firms and medium-sized firms, that's not very easy to do. So alliances with others elsewhere in the world is going to have to be the name of the game, and looking at different markets. But of course, everyone will be doing that. So working jointly, I'm afraid, has to be the way forward.
Yeah, I mean, some UK exports, like automotive, we talked about that, see these tariffs as a threat. Others spot opportunities to pivot. Who do you think are the winners and losers in this tariff landscape?
It's interesting. He talks about some that might do well. Some might do well simply because the tariffs here are a little bit lower than they are elsewhere. So there could be some opportunities. And there are discussions. If there are discussions to reduce those tariffs completely and eliminate them, then yes, there would be opportunities, but also opportunities to bring in some American products if our own tariffs get reduced. Which, if other countries don't quite manage that, then that's an issue. So we could have some advantages there, both ways in terms of how the traffic of trade might go. So there are indeed some opportunities there, but other countries will be trying to do something similar. So even if there is some agreement between the UK and the US, then you wonder whether others will strike similar agreements at a later stage. So whatever plans you put together thinking you had a comparative advantage will disappear. So I'm afraid comparative advantage is still the name of the game in trade, as we learned in our textbooks in economics.
Yeah.
And what we need to do is just remain competitive, but also look at the opportunities that are available elsewhere and working in cooperation. And Europe, of course, is the obvious one for us.
Yeah, and as you say, I mean, for UK businesses, they're facing these higher export costs due to these tariffs, a topic you've been dissecting regularly. What practical steps then can they take to adapt their supply chains or pricing strategies?
Well, that's interesting. Of course, I also get involved with the chambers of commerce, and of course they get precisely that type of question all the time. Of course, the chambers want the government to negotiate, free trade as quickly as possible. But of course, there may well have to be some concessions that we give. So again, we don't know what those concessions might be, so we have to just watch it a little bit. Although they could be more on the services side. Those concessions, we touched on services at the beginning of this, so they're bound to come under some sort of scrutiny at some point. But basically look at one's supply chain a lot more carefully. And I think, as you hinted at, seeing, how one can perhaps simplify it or take advantage of the links that might exist. Because we talked about the car industry, the supply chain between us and here in the UK and Germany remains, despite Brexit, very strong. And if we can look at ways to convince the government to move into removing some of the restrictions that exist in practice, even though there are no tariffs between the UK and Europe, that's going to be a huge, huge help for SMEs in particular, but for particular sectors as well, such as the car industry and other industrial products, where Europe really is quite significant from that point of view. So it's not an ideological thing, it's a practical issue. We know, again, from information that the chambers have, that about a third of SMEs have simply stopped trading with Europe, and that is pretty bad because we do need SMEs for productivity and growth and for employment. So it's basically re-examining also where some of the markets might be. Given, though, that some of those emerging markets, Southeast Asia, have all been hit by those extra tariffs, you wonder about the supply chain issues, whether, of course, in some cases they might be much more willing to work with us rather than diverting some of their products to the US. They might, or selling some of the products to the US, they might decide to have closer cooperation with us. So depending on which sector you're in and the reach and ease of supply chain connections that you could have, then there are some opportunities that come out of this. If you look at what's been happening to loads of other countries and their relative hit by President Trump. But as I said, the trouble is that you could set something in motion and then everything changes.
Yeah, I think that's
And
the
that
problem,
is,
isn't it? Yeah.
it really is. So the general advice has been, sit tight and wait. But how long can you wait? That
Well,
is
and
the question.
it's certainly the thing. I always make the point when people are campaigning on change. I always say the most important change is the change in people's pockets. And now, obviously, households are bracing for price hikes from this trade war. What economic planning tips would you offer the average UK family to manage their finances in this climate?
Well, I'm afraid be careful. What we've seen is that people have gone out and spent recently. So retail sales have been quite recovering in the last few months. So there is money around. And we're getting, of course, as of this month, the increase in minimum wage, which is quite significant, way above inflation. We have seen some quite generous pay settlements in the public sector. We've got those savings, which are quite high by historical standards. So people still saved a lot at the time of COVID, those who were able to, that is. So a large percentage of the population still has quite a lot of money in the bank. But they will be worried about jobs. And so wait and see, I'm afraid, in that case too. So I'm fully anticipating, of course, the weather is improving in the UK, has improved. People have gone out a lot, have spent. So probably going to see that April is a good month in terms of going out and eating and so on. But until recently, we've seen that, yes, people go out and take advantage of discounts, which are increasing all around you. They're not necessarily spending much in hospitality, which is in difficulty right now. They may do a little bit more of that because of the nice weather, then cut back on other things. I think there's going to be a lot of caution as to weather because of everything that's happening, tariffs, etc. But also the increase in national insurance contributions by firms may mean that employment possibilities are fewer in the future. But look at the interest rates, look at taking advantage of what is on offer. And in many ways, again, I'm afraid for the consumer too, wait and see, because actually things may improve in terms of your cost structure after this month's increase in all those bills. If you wait long enough, but I'm afraid there is a worry that unemployment may increase as well. So caution probably is what everyone is thinking about right now. Let's see what happens.
Okay. Don't panic, I guess, is the answer then. And we'll keep reviewing it. We'll get you back regularly to follow up on that. But for now, Vicky Pryce, thank you very much for joining me.
Thank you very much.
And sorry, one final thing, Vicky, before I let you go. Oil prices, obviously they're coming down. Talk to me about that.
Yes, I think that's interesting. It's partly, of course, President Trump had said all along that he wanted to see the oil price reduced to, if you like, affect what happens in the global oil industry. But of course, it affects US producers as well. But for the rest of the world, it's quite good news that oil prices are coming down. There's been an intention by OPEC, which is the Organization for Petroleum Exporting Countries, which includes Saudi Arabia and, of course, also Russia as an OPEC plus country, to increase production again, because there have been some countries that have not been keeping to the previous cuts and production constraints that have been imposed, including Kazakhstan and some others, and Iran. So everyone is supposed, the rest, increase production as well to in a way make up for the fact that some have been doing it anyway. That expectation of increase in production had already started bringing oil prices down. And with the slowdown in the world economy now that is forecast, what we're seeing is that oil prices are coming down further than people had anticipated. And everyone is revising their expectations for where perhaps prices might be at the end of the year. So, in fact, there are some estimates that whereas now we're hovering around sort of $70 a barrel, if you look at either WTI or Brent, it may in fact be near $50 a barrel by the end of the year. If that is the case, then petrol costs at the pump might be going down. So that's another positive in terms of looking at the overall structure of costs, if you like, that the consumer has to face on a daily basis. And of course, that brings inflation down further. And with that, hopefully, interest rates come down faster than would otherwise be the case.
Excellent. We can finish on a positive note for today. Anyway, a bit of hope. Vicky Pryce, thank you very much indeed.
Thank you.